Let me know when you're recording. All right. How's it going, guys? This is going to be Learn the Market Mastermind 1.0 Day 2. Today, we're just going to be covering options, specifically how they're priced and, the factors that go along with that, specifically the Greeks. So let's dive right in. Just going to do a quick overview of our agenda, the concepts that are going to be covered. These are it, starting with obviously introductions to the option pricing, going into intrinsic value, time decay, and then, as I said, the Greeks, and then, just some practical examples to really drill in those concepts and basically give them examples behind them. So, introduction to options pricing. So the main things that you guys need to keep in mind when it comes to options and the fact that they are a financial derivative, they derive their price from two things, right? So they derive their price, since they're a derivative, they derive their price from the underlying stock. In this case, it could be the intrinsic value, right? And then the time value. Something that is super important is the fact that options are a wasting asset, and that deals directly with time, and that is something that we'll cover later on dealing with the Greeks, but that is something that you guys do have to keep in mind. So just two fundamental components when thinking about the pricing of the options is just the intrinsic value and then the time value, which could be also known as the external. And then the intrinsic value, as you guys see right there, is also could be known as the that's the premium, which is the price of the option. So let's continue. So these are the main components, I would say, if you want to look at them as the main components, what you're going to actually see on the option chain when you're looking at a contract. And we're going to have an example of that in a picture where you guys will actually be able to see that. So the main things that you're going to have to look at basically are the underlying price, as I said, the underlying security of the option. So let's say if you're trading SPY contracts, SPY in this case would be the underlying asset. Same thing for Apple, Tesla, so on and so forth, right? The strike price, this is the price at which the contract can be exercised. And the strike price is pretty much, it's just set when the option contract is written and does not change over the life of the option. That's when you see, for example, 420 puts, 425, 430s. That's something that we covered already on day one. Very basic. Now, this is something super key, and this is something that we're also going to cover, as I said, in the Greeks, but this is something you do have to pay attention. So time to expiration. As I said, contracts and options are a wasting asset. So the expiration that you're going to see on these contracts is basically the time remaining up until the option contract expires. And as I said, I'm going to drill it in home. Options are a wasting asset, which ultimately means that their value decreases over time. As they get closer to expiration, you're going to see that increase. And as I said, I'm just going to repeat it again. We will go over that in the Greeks. Then we have volatility. That is the measure of the amount by which the price of the underlying asset is expected to fluctuate in a given period. And just volatility is a crucial component of options pricing, simply because when there is increased volatility attached to that, we like to basically see, or we observe, that option prices are actually higher, as we see IV, how we like to call it. That's implied volatility. That's also something we'll cover. But basically, as volatility is going up, option prices tend to be higher because of the likelihood that that option will then move into the money before it expires. And then you have the risk-free interest rate. That is the interest rate that could be earned on a risk-free investment, such as a US Treasury bond. The risk-free rate is used in the pricing of options because it represents the opportunity cost of investing in an option as opposed to a risk-free investment. It's very basic. Let's continue. Now just explaining extrinsic value and intrinsic value, right? Excuse me. Let's start with, okay, got you. Go ahead.
So intrinsic value, this is the value that any given option would have if it were exercised today. So in other words, it's the amount by which the option's in the money. So for call options, it's very simple. Intrinsic value is calculated as the current price of the underlying asset minus the strike price of the option. And for put options, it's the opposite. It's calculated by the strike price of the option minus the current price of the underlying asset. I'll get into a better example with you after. You could read this one if you like. With extrinsic value, it's also known as time value. It represents the additional premium that's priced into an option for the amount of time remaining until the expiration date. Extrinsic value is influenced by factors such as volatility, time decay, also known as Theta, which we'll get into. It's one of the Greeks, and interest rates. Here's an intrinsic value of options example. Using the house example from day one, guys, you remember I said the house price is $150,000 value right now. But the strike price for the contract that you wrote with the owner is $100,000 strike price. Since you could buy the house for $50,000 less because that's your strike price, then its current value, which is $150,000, a $50,000 gain in your strike price, the call is set to have $50,000 of intrinsic value. So once again, for intrinsic value, you would subtract the strike price from the current price of the asset, which is right now the stock. it is $0 intrinsic value if the stock price is below the call's strike price. So here we'll look at the example for the call option right here. $150,000 stock price, which is the house, minus $100,000 call strike price, which is the contract you wrote for the house. You would subtract that, and that's how you get your intrinsic value, which is $50,000 in this example. So the call can buy shares for $50,000 below the stock price. That's the intrinsic value. Now, for put options, like I said, it's the opposite. So it's the stock price subtracted from the strike price, and it's zero. And the intrinsic value is $0 if the stock price is above the put strike price. So here's the example: $150 put strike price minus the 120 stock price equals a $30 intrinsic value. The put can sell shares for $30 above the stock's price. The put has a $30 intrinsic value. It's very simple. Once you understand the basic equation for it, it's fairly simple. Here's the visual for that. So we have $50 strike price, right? Let me draw here. So we have a $50 strike price, correct? Now, if you have a call option that's in the money, meaning the stock price is now at $55, your intrinsic value is $5. Why? Because you're subtracting the current price of minus your strike price, right? Now, for the put options, like I said, it's the opposite. So you'd be subtracting the strike price minus the stock price, and it gives you a $5 intrinsic value because the price of the asset is below your strike price. Make sense? It's a fairly simple concept once you understand it. Here's an example on the actual options chain, right? So right here we have Apple's price. Apple stock price is $179.21. You see right here, the last price is $179.21 right there. The call option we're going to be looking at is the June 16th, 175 strike price call. Why is it a call? Because it's on the call side. This is all the call side. The right side is the put side. As you see, it says calls right here. Let me draw on here for you again. Calls, right? We're looking at calls here. Not only looking at calls, but we're looking specifically at the 175 calls. As you can see, they're in the money. Why are they in the money? If you guys remember for our first lesson, in the money states that if the strike price is below, if the strike price is below the current assets price. So our current assets price is 179.21 and our strike price is 175. As you can see, it is above. To get our intrinsic value, like I gave you guys the equation in the last slide, you would subtract the current assets price, which is 179.21, with your strike price, which is 175. Your intrinsic value would be the equation of that, which is $4.21. Now, to get the extrinsic or the time value, you would subtract the options price, which, as you can see right here, is 555. Why is it 555? Because this is the ask. The ask is what someone who owns that contract is willing to sell it for at this very moment. They are asking for 555. You would ask, why isn't the price 540? Because that's the bid. That's what I'm willing to pay for it as a buyer. That's not the current price. The current price is what the current ask is, and that is 555. So you subtract 555 minus the intrinsic value, which is $4.21, which gives you the time value of $1.34. And as you see, the time expiration is 10 days because it is June the 6th. It's fairly simple. Don't make it too complicated. It's very simple. Now, with extrinsic value of options, options with more time to expiration will trade with much more extrinsic value or time value compared to the same exact option with less time to expiration. What that means is, if I get an options contract that expires at the end of the week versus an options contract that expires at the end of the month, the one at the end of the month will have much more extrinsic value because it has much more time on it. It's simple. Extrinsic value is time value. The more time, the more extrinsic value. The less time, the less extrinsic value. Now we'll look at two different call options with the same strike price and different expiration dates. The one with the further out expiration date will be trading with significantly more extrinsic value because there's much more time left for the stock price to move. So let's say this. If, like I said, the contract expires on Friday, the price of Apple is 150, and you have 140 puts for the end of this week, but we're sitting in a range between 145 and 150, having only a few days for your contract and the low amount of extrinsic value, it's not going to give you enough time value for your contract to gain its intrinsic value, because your contract is going to be losing time decay. And we'll get into that, which is a theta. Now let's take an at the money 130 put option with 30 days to expiration, for example. The stock price is 130.50. The put option has no intrinsic value, but the fact that it's at the money with 30 days expiration causes it to have its time value. The premium. A fall below the strike price would cause a significant gain in intrinsic value. Why? Because once again, if the price in a put scenario, if the price falls below the strike price, intrinsic value gains. Make sense? Just because an option has no intrinsic value does not mean it's not worth anything. Because the fact that this put option has a $0 intrinsic value, but it's at the money with 30 days, you still have so much more time for the stock to move and for your contract to gain that intrinsic value. So it's always better to get further out contracts so you have time to gain your intrinsic value on your contract. Now, extrinsic value, it's also known as time value, one of the most critical components of an options price. It reflects the potential future value of the option and decreases as the option approaches its expiration date. The decrease is known as time decay. Time decay is the Greek called theta. As the option gets closer to its expiration date, the extrinsic value decreases by the theta. It's because there's less time for the underlying asset to make significant moves towards your strike price. The rate of this decrease accelerates as the option gets closer to expiration. The phenomenon is known as time decay or theta. So, for example, let's say my contract expires at the end of the week. We're going to use the same example. My theta on my contract is 0.25. That means for every single day, for today specifically, today leading into tomorrow, my contract will be worth $25 less if the stock price stays the same. Now, let's say the stock price stays the same 2 days in a row. Tomorrow, my contract won't have the same theta. It'll have an even higher theta. Why? Because less extrinsic time value left. We only have, instead of 5 days left, we have 4 days left. So now instead of 0.25 being my theta is now 0.35. So now instead of me losing 0.25 a day, I'm losing 0.35. Then the next day, 0.45. The next day, 0.55. Until on the last day, meaning if it's Thursday and the contract expires on Friday, my contract will usually, almost always, if you're getting it at the money, a little bit below the money, unless it's in the money and has that intrinsic value, your contract will have a theta of the actual contract's value. So let's say it's Thursday. Your contract is worth 1.00. If you guys remember, that means it's worth $100. My theta will most likely be 0.99, meaning that tomorrow my contract will be worth $1 because of the extrinsic time is gone. I have only 1 day to my expiration date. Versus if I had a contract that expired in a month from now, my theta would be much, 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 much less. Most likely like 0.05, 0.06. And the day after that, it'll only raise maybe $1, maybe $2, and then so on and so forth. So volatility, which is known as Vega, the more volatile the underlying asset, the higher the extrinsic value. It's because higher volatility, which is also known as IV, we'll get into that later, increases the chance of the option moving in the money before expiration. The Vega represents the amount of options price changes in response to a 1% change in the volatility of the underlying asset. Interest rates. Don't see too much of this flip-flopping with most assets, but interest rates impact the extrinsic value. When the interest rates rise, call options typically increase in value and put options decrease because higher interest rates increase the cost of holding the underlying asset. All right, let's understand the Greeks. Because understanding the Greeks is crucial for every trader. If you don't understand the Greeks, don't trade. Options, at least. So for delta, delta measures the rate of change of an options price with respect to the changes in the price of the underlying asset. So let's give you an easy example, right? So let's say the price of the asset is now $100, right? This is the stock price. So $100. Now my contract is worth 0.35. This is my contract. Now, my delta is 0.08. Let's do that. This is my delta, right? It's a horrible delta, by the way. You do not want a delta this low. Let's just use it for this example. I'll give you a good example because you really wouldn't buy that. Let's do the contract's price is 1.25, right? This is the contract's price. My delta is 0.3. This is okay. It's like the lowest you'd go. That's my delta, right? This is my delta. I'll mark it as D. This is my price of my option. I'll put that PO, right? And this is the price of the asset. So I'll put, I'll put SP. That's a stock's price, right? Now, if the stock's price increase, by the way, this is a call option, 1.25. So I want the stock to go up. If the stock's price goes to 101, I would add that 30 to my contract's price. Why? Because for every dollar that the stock goes up, so does your contract value with its delta. So for every dollar the stock goes up, you look at the delta, and that's how much your contract will go up. So if the stock goes up to 101, my contract goes up to 155. That makes sense? And then as your contract gets further into the money, which let me show you an options chain real quick so you can get a feel for how that looks. Once your contract gets further in the money, your delta rises. So we'll take a look at that right now. Let me pull up the options chain. New share. You can see my screen, right? You can see the options chain?
Yes.
Okay, perfect. So you see here, the delta is 0.46, right? You have a 0.46 delta for the 180 at the money. In the money is 0.61. So once this contract gets to in the money where 177.5 contract is, the delta will be similar, or it will definitely get higher. It might not be the same exact as 0.61, but the delta will rise as the contract gets further in the money. So let's say Apple was before at 160, right? So its deltas for the 170s, the 170 contracts used to be down here. 170 contracts used to have a 0.19, 0.31, 0.46, but the further it got in the money, the higher its delta got. That means for every dollar now that Apple goes up, this contract right here is gaining $88 on its contract, right? This one 82, this one 73, this one 61, this one 46. Now we'll take a look at the put side. It's the same but different, right? So that means for this delta, it says it's a minus sign, but it's the same thing. It adds on to your contract. So right now, if the stock went down $1, your contract would go up its delta, which its delta for this contract is 0.38, right? It's a very simple concept. For every dollar that the stock goes up or down, the delta adds onto your contract. So if you have calls, every dollar goes up, the stock, you gain your delta on that contract. Now, the same thing for puts. For every dollar the stock goes down, you gain the delta on your contract. I'll just get right into theta since we're already talking about it. Theta, which is also known as the time decay. Remember I told you, if you held this contract right here into tomorrow, it's going to lose $14 because that's the time decay. That's the theta. The theta tells you how much your contract is going to decrease in value per day. And this varies day by day. And it varies by the price point. As you can see, the different prices, the different thetas. It's very simple. Do you guys understand that concept, or do you want me to go over that concept again? It's fairly simple. Delta, theta. Delta tells you how much your contract is going to increase in value or decrease in value. Because if the stock goes down and you get calls, your delta is going to affect your contract negatively. Versus puts, if the contract goes up, it's going to affect your contract negatively. Entiende this? I mean, it makes sense. It's very simple. Theta, once again, for every day you hold your contract, the theta tells you how much your value of your contract will lose. So tomorrow, this contract right here will only if, by the way, guys, only if the stock price stays the same, because if it drastically changes, the theta will be a lot different. Because why? The price will be further in the money or further out of the money. But this tells you how much your contract is going to lose automatically. So automatically tomorrow, the contract is automatically lost $14 in value, no matter what. Make sense? Yes? Let's move on. Here's a real world example. Consider Apple's call option with a strike of 150 expiring on June 16th, 2023. The option's delta is 9.6. The gamma is 0.0044. The theta is minus 0.093. And the Vega is 0.0272. This means, once again, for every $1 increase in Apple's price, the options contract price will increase by approximately 0.96. It will increase by the delta. For every $1 in Apple's price, the options contract will increase by its delta, no matter what the delta is. The options delta will increase by approximately 0.044, which is the gamma. The options value will decrease by approximately 0.093 each day due to the theta, once again is known as time decay. Why are you losing that? Because of the time decay. So your contract tomorrow will automatically lose $9.30. The option's value would increase by approximately 0.0272 for each 1% increase in volatility, which is known as the Vega once again. Now, let's consider an Apple put option with the same strike price and expiration date. Notice the delta is a minus sign, but once again, it doesn't necessarily mean it's going to subtract from your contract. Once again, if the price increases, for this example, if the price increases in Apple's price, the options price will decrease by the delta, but vice versa. If the stock price decreases, then your put option will increase by the delta. Does that make sense? Are you guys understanding how for every dollar it moves, the deltas affects your contracts? And then the same way for theta, for every day you hold your contract, your value of your contract loses by the theta's amount. Those are the two main things you look at when you're buying a contract. What's the delta? What's a theta? Why? Because I need to know how much money I'm going to be making on my contract for every dollar it moves. For example, if I believe the stock Apple is going to go to 155 and I have a $153 call and my delta is 0.35, I know that I should gain at least $70 on my contract hitting my price target. Does that make sense? Because for every $1, my delta was 0.35 at least, because once again, as the price goes further towards your price target or further in the money, the higher the delta gets. So approximately I would gain 0.35, which is $35 for every dollar it moves. And then if I hold my contract, let's say my theta is 0.05, tomorrow my contract will be worth $5 less. Why? Because it's 0.05. 0.05 in options terms means $5. 1.00 is $100. Remember that, guys. All right, here's we're going to do an example of each. All right. So for delta, suppose you own a call option with a delta of 0.60. The underlying stock price increases by $1. Once again, the price of the call option will increase by approximately 60. Why 60? Because that's the delta. Conversely, if the stock price decreases by $1, the price of your call option will decrease by approximately 60. It will decrease by your delta. Your delta tells you how much your contract is approximately going to move based on $1 increments on that asset. The theta. Suppose you own a call option with a theta of 0.05. For each day that passes, with all else being equal, the price of the call option will decrease by approximately 5 cents due to time decay, which is $5. So if your call option was $100 and the price stays the same into the next day, your contract tomorrow will be worth $95. Does that make sense? Yep. Gamma. Yes. Suppose you own a call option with a gamma of 0.10. If the underlying stock price increases by $1, the delta of the call option will increase by approximately 0.10. So if the delta was initially 0.60, it will now be 0.70. Remember how I said the further your contract gets in the money, the higher the delta gets? That's based on the gamma. So if the gamma is 0.10, your contract delta will increase by 0.10 for every dollar it moves. So let's use another example. If your contract, let me draw it out for you guys again. If your contract was 1.00, that's your contract's price. Your gamma was 0.25. Your delta was 0.50. Let's say the asset's price was 152. Sorry for my horrible handwriting. Let's say the price of the asset, which is the stock right here, went up to 153. That means your contract gained its delta, which is now worth 150. And your gamma is now, your delta is now 0.6. Oh, I'm tripping. I'm fucking tripping. Is now 0.75. Sorry. Why? Because that was the delta, right? It's just an example, just so you guys understand how it works. So stock price increases, you gain your delta, and your delta gains its gamma for every $1. Vega. Suppose you want a call option with a Vega of 0.20. If the IV of the underlying stock increases by 1%, the price of the call option will increase by approximately 0.20. Conversely, if the IV decreases by 1%, the price of the call option will decrease by approximately 0.20. Let's take a look at that on the options chain. So our Vega on our 175 is 0.10. So if we go up 1% in IV, your contract will go up 0.10, which is $10. And I'll do the same example with the gamma so I can show you on the options chain. If your contract, if the stock price gains in $1, your contract for 175 will gain 0.73. The gamma will add onto the delta to now make it worth $5 more, which is now 78. So 0.78 will now be your delta. That means for the next dollar it moves up, your contract will gain $78. That makes sense?
Yes, sir.
And then I'll be honest with you guys, I don't use this. Call example for Greeks. So we'll look at the option in here. And I need you guys to answer this for me now. Based on everything I've already talked to you guys should have a basic understanding of these concepts. So we're going to take the 180 strike price for this example, right? Which is right here. So you guys don't get confused. 180. You see strike? 180. I'll draw it completely so you guys don't get confused. These are all your components of your contract for the 180 call, right? This is your delta. This is your gamma, your theta, your vega. This is your ask. The bid doesn't matter because the ask is the price that you would pay if you were to purchase it at this very moment. Identify the Greeks, which I've already marked for you, and answer these questions. If the price of the stock was $179 at this current moment, and the price rose to $180, how much would the $180 calls contract increase in value? Now, if the price of the stock's price stays the same and you hold your contract until the next day, how much would the contract lose in value? Hannah, do you know? Well, if the stock's price was $179 at this current moment and it rose to $180, that means it gained $1 in the stock's assets value. The $180 call would gain its delta, right? So you would add the delta to the ask, which is what you paid, and that's how much your contract would now be worth. So it would be 229 plus 46. It's now worth 275. Your contract's value is now 275. Why? Once again, you add your delta to your contract's current value because we went up $1. Now, conversely, if the stock's price stayed the same, it stayed at 179, it didn't move from there, it stayed at 179, and you held your contract to the next day, you would lose your theta. For this contract in specific, you would lose automatically $14 on your contract's value. Simple? I know. Here's practice exercise number 2. Let's use Apple's call option with a strike price of 150 and expiration date of June 16th, 2023. For conversation purposes, today is June 6th, so that is a 10-day from expiration contract. Here's the details of this option. The break-even price is $179.52.5. That's the price of which you will be at a break-even, because remember, you pay a premium to get into that contract. So you're automatically, most of the time, down on your position as soon as you enter it because you're paying a premium. Your break-even for this contract right now is $179.52. The underlying price, which is the current value, is $179.06. You need the price of Apple to go up to $179.52 just for your contract to be worth what you paid, right? Now, your options price, which is known as a premium, is $2,955. How much is that? $2,955. Your delta is 0.96. Your gamma is 0.043. Your theta is 0.09. Your Vega is 0.027. Your IV is 0.62. And your OI, which doesn't matter in this situation, is 31,399 contracts. Understanding delta, if Apple's stock price increases by $1, how much would you expect the price of this call option to change? Toto, you want to answer?
Yes, I got this. It would just be $96.
Your options contract price will gain by $96. Why? Because
Which
that
is the
is your
delta.
delta. Understanding gamma, if Apple's stock price increases by $1, how much would you expect the delta of this call option to change? Why the delta? You got to remember, because for every dollar it moves up, the gamma adds on to your delta to move up as well. So in this case, your gamma would add on to the delta, and your contract would gain by 0.0043, which is nothing because this contract's so in the money. As you can see, the deltas don't get more than 1.00. The delta does not go more higher than 1.00. Remember that. All right. 100 is the highest the delta goes.
That's why you see the gamma so
That's why the
low.
gamma is so low.
Yeah.
Understanding theta. If 1 day passes, which means if I held my contract from Monday to Tuesday, and the price stays the same, which is meaning all other factors. So the price stays the same. The price stays at 179.06 in this area, right? It doesn't really move too much. How much would you expect the price of this call option to change? Theta, $9. Your contract would automatically lose $9 because that is your theta. Vega, if the IV increases by 1%, how much would you expect the price of this call option to change? It's right there. Very simple, guys. Understanding intrinsic and extrinsic value. Now, this is where you have to do a little bit of math. If Apple's stock price is $160 at expiration, what would be the intrinsic value and the extrinsic value of this call option? Mind you, your strike price is $150. Do you remember the equations of how to get your intrinsic and extrinsic value? Still no. If you guys do know, I'm not trying to give you the answer too quick, so I'll let you think about it. Excuse me. Okay, so I will tell you the answer now. So you will subtract the 160, which is the current stock's price, minus your strike price. Correct. So to get your intrinsic value, you subtract the current asset's value minus your strike price. Why? Because this means that I can gain $10 on every share if I were to exercise this contract. That's my intrinsic value. That makes sense? Very simple. Very simple. If your contract is in the money, which means the stock price is higher than your strike price, that means you have intrinsic value. If your stock price is the same, you have a $0 intrinsic value. If your stock price is below, you have $0 intrinsic value, right? And the only thing you'd have on that is extrinsic value, which is the time value. Now, what would be the extrinsic value in this case? Your intrinsic value would be the amount which the price of the option exceeds in intrinsic value. You guys understand this or no? See or no?
Yes.
Listo.
In that case, it would be the 10 minus the option premium, right?
Yes, exactamente. Exactamente. Let's move on. Here's the answers for that for you guys that are not watching it currently live. You guys would have that. Here's the options terminology for today. We learned about intrinsic value, extrinsic value, also known as time value, our Greeks, which is the delta, gamma, theta, vega, our rho, and implied volatility. You guys can go over this yourselves afterward to better understand this if you guys don't remember. Here's a recap of today. Intrinsic value is the difference between the stock price and the strike price of an option. Once again, we literally just went over that example. So if our strike price is 150 and the stock price is 160. That means our intrinsic value is $10. Why? Because you subtract the current asset's value minus the strike price, which gives you $10 intrinsic value. Extrinsic value, on the other hand, is the part of the options price that is not intrinsic. It's influenced by factors such as time decay, volatility, and interest rates. We then moved on to the Greeks, which we went over the delta, the gamma, the theta, the vega, and the rho. You guys remember the delta is how much your contract moves for every $1 change in the price of the underlying asset. The gamma is the rate of the change of the delta for every $1 of the change in the underlying asset. The theta represents the time decay, or how much value an option loses each day you hold it. The vega measures the sensitivity to volatility. And the rho is less commonly used. Like I said, I don't even use it myself, but it represents the rate of change of an option's price with respect to interest rates. Now, an overview of day 3. Day 3, we'll be moving on to more advanced topics in options trading. We'll start by understanding IV, which we talked about a little bit today, but we're going to get into deep tomorrow and how it affects the options pricing. We'll then learn about the different options trading strategies that you can use, such as long calls, long puts, covered calls, protected puts, short puts, and various spread strategies and strangles. We will also discuss the concept of options chains and how to read them. I know we went a little bit over them today. As you see, once again, this is an options chain. This is where you look for your different types of options. So I'll go over it a bit with you here. These are all your dates, right? What are these dates? Your expiration dates. These are when the contracts become worthless, essentially. They cannot be traded no longer. They cannot be exercised. They essentially are gone. As you can see, anything before June 9th is gone. Why? Because they're expired. Now, sorry, let me stop drawing. Let's say we want to go September 15th. As you can see, the premiums on these contracts are so much higher. Why? Because of the extrinsic value, the time value. It has so much more time for the asset's price to change and go towards your strike price, for you to go in the money, for your contract to gain intrinsic value. Now we'll go to June 9th, and you can see the contract's values are much lower. Why? Because our extrinsic value is so much lower. Our intrinsic value is also much lower. And then tomorrow, as you can see, the theta on this contract is going to lose 0.29. This contract is going to lose almost 25% on the contract, a little more, over 25%, just for holding the contract because of the lack of extrinsic value, the lack of time left on the contract. And as you can see, conversely, on this contract, its theta is 0.05. You're only going to lose $5 on an $890 contract versus losing $29 on an $111 contract, $20 on a $43 contract, which is almost 50%. You see how it differs? When you have more time value, you have less decay of your contract's value. It's a very simple concept. Very, very simple. So this is the options chain, guys. We're going to go into it deeper tomorrow, how I look for my contracts, how I find my contracts, what contracts attract me. We're going to go over what deltas I like to look at, what thetas I like to look at. So yeah, that's it for day 2. I hope you guys understood everything. If you have any questions at all, feel free to ask them. And yeah, that's it, guys. If you have any questions, let me know. If not, thank you. No problem, Hannah. This will be recorded and will be uploaded once it's finished. Have a good one, guys.